You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. Welcome back to Options Playbook, the program here on the old network where we break down the sometimes scary, sometimes seemingly impenetrable world of options into some very basic, easily digestible offensive and defensive plays you can utilize in your own portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network. If you're saying to yourself, wait a minute, that guy's not usually on this program, you are correct. So let me toss it over to the fellow who's usually holding down the hosting chair here, Mr. Brian Overby, the senior options analyst, a.k.a. the options guy over there at Ally Invest. Mr. Overby, welcome back to your own program, sir.
Well, it's always great to be back on such a great, wonderful option radio show. But obviously, today we were getting into SPX 3000. All the hats are getting broken out on the exchange, and what that usually means is that there's some complacency in the marketplace, which is kind of odd because the VIX definitely hasn't been complacent overall. Mark, I thought it would be great if we got together and talked about how to hedge your positions, your portfolio, whenever we see a big number like SPX 3000. I think it's always a great time to talk about how you can protect your portfolio, not to mention the fact we got September, October. We all know what happened last year in December. So I think it'd be great to maybe look at some protected puts, some collars, and even some derivations of those strategies. What about you?
I think that's a great idea because this is that time of year we're coming into. Obviously, it's hard to believe we're already in September. The year is just cranking away, but we already in September. We're threatening on the cusp here of Q4, so people are starting to look at their year end, how they handle their portfolios. Maybe they have some gains, maybe they have some losses. If they're long equities, chances are they're sitting on some gains these days. So this is that time of year where they start thinking about these kinds of things, Brian. They start thinking about hedging and what they should do, and there are so many ways they could do it. In fact, a large section, a large swath of your playbook is devoted to just that. I think what makes it interesting right now in particular, Brian, too, is like I said, we're coming into end of Q3, beginning of Q4, and Q4 is always a weird beast, particularly from a market and from a volatility perspective, which we as options traders, we always look at things from that volatility lens. And, you have this, first off, this widely held belief out there that, they Rocktober. They call it that for a reason. October, of course, we had the 87 crash, many other meltdowns around that October timeframe. So October has a reputation, rightly, maybe wrongly. I think if you crunch the numbers, October is actually not the most volatile month of the year, even though it has this perception. August of late has been very volatile. And then the flip side is also true. People also believe the end of the year December, very quiet, the holidays, people are on vacation. Not a lot really happens in the markets there as well. In fact, if you look at the broad volatility marketplace right now, the VIX marketplace, the VIX futures in particular, that tells you exactly what the market is expecting for the different months of the year from a volatility perspective. And for pretty much the entirety of 2019, December has been the lowest mark on that board. You could roll from October to December and get a credit, actually. Volatility was priced higher in October than it was in December. And you might say historically, that might make sense because the holidays are usually a quiet period. But looking in the last few years, and again, past not always prologue, but if you take a recency bias into consideration, the last few years, certainly, December has been a very tumultuous period. In fact, December 24th, Christmas Eve of last year, was the nadir for many names in the marketplace. They all hit their lows of the year there and then bounced off them as a result. So we've seen a tremendous amount of volatility, which the market, at least right now, seems to be underpricing. So, Brian, this is a long way around to me saying I think this is a good time to talk about protection out there. But, Brian, let's say you're talking broad index, right? 'Cause a lot of our listeners like to trade S&P, the SPY. That's an expensive place to go. If you want to just go and buy a 3% out of the money put right now in SPY, you're going to be paying through the nose for it right now. So what are some ways we could maybe finagle that a little bit to make the cost not quite so onerous, sir?
Well, yeah. We're going to talk about collars, I guess, to start. And I think the best way when you see expensive option contracts, and you're just really worried about a time period. Now, here's one of the biggest things about hedging or buying some protection. It's expensive in the stock market, right? The odds of your stock going down versus your house getting knocked over by a hurricane, they're a lot higher in the stock market that your stock could go down, 15, 20% over a few or 3 or 4 month period. So you always want to be cognizant of the actual cost. And so the math is fairly simple here today because we're looking at the SPYs. I look at them right now. It said they closed today, and we're taping this episode of Options Playbook Radio. It's always important to note. On Wednesday, September 11th, the markets are closed. We did just close above 3,000, but just barely in the SPX, which puts the SPY at $300.25. So, Mark, I'm going down and I'm like, okay, well, where's 5% level? The math is simple. It's 15% below. That would be where I'd be interested in maybe buying a put. And if I look at that put, that's trading for, on the asking price of $6.30. The bid's actually $6.24, so a really good market as usual in the SPYs. But I'm going out to January. I'm trying to get through all these volatile months, looking at 15 points out of the money, and it's $6.30. And a lot of people do that, and they say, gee, $6.30. I don't, I'll just sell when it gets down to that range. But we all know how that happens and how that works when we get the big gaps down. So it does get fairly expensive. So one of the things inside the options playbook that we have always highlighted as a decent hedging strategy, if you're just worried about the short term, getting into the new year, is to actually sell a call to pay for it. So, Mark, here's what's kind of concerning to me is I went out and I looked, well, what's the call option 15 points above or 5% above? And back in the day, it used to seem like that call could almost pay for that put. It'd be fairly close, but with the markets the way they've been and the volatility and what we, I guess, on the floor always called volatility skew or tilt, if you will, throughout the different expirations and the calls and the puts, they always seem to lean a little, that volatility level seems a little bit higher on that out-of-the-money put. And because of that, 15 points out of the money on the call is trading for $3. So it's still not quite saving you. It's not paying for that protection. So let's say, for example, today we went in and we bought 100 shares of SPY and paid $300 for that, and then went out and bought the protected put, 5% below it, $285 in January 17th expiration. That would cost us $630, and then to try to help pay for it, we go 15 points above and we sell the $315 call with the same expiration. We're only bringing in about $3 on that, so it's fairly expensive. So I know we chatted a little bit about this. What's another alternative to get that put paid for?
That's probably one of the number one questions we receive here on the network across the broad spectrum of all of our shows. Retail guys, professionals, asset managers, a large number of RIAs. In fact, we talk Collars almost exclusively, it seems like these days, on our Advisors Options program, because that audience is very much interested in this approach. And there are so many different ways you could construct the collar. In fact, if you're interested in collars, listeners, I definitely encourage you to head on over to the OIC's website, optionseducation.org. The OIC is the Options Industry Council, a great industry advocacy group. All they care about is educating and spreading the gospel about options. And if you're there, you search for their collar study. They did a great collar study where they walk you through a myriad different permutations of how you can construct a collar on different underlying, so broad equity indices, gold, you name it, and how they constructed it a year out, 6 months out, 3 months out, adjusting the collar, all different things. It is really, if you're interested in collars, it's definitely something I recommend. To my knowledge, it's the only real study of its kind out there that's done on such a broad, wide-ranging level, analyzing collars across so many different variables and different use cases. And again, they determine for their use case, they like a 6-month put with the call usually in the 1 month side, and they roll that call every month. For our purposes here, we're kind of trying to keep things a little bit simpler, try to keep it. A lot of people like that zero cost collar. I'm not a huge fan of going out with the mantra of trying to find a collar that costs you nothing, because it usually ends up not working out as favorably as you want. You have to get into some strikes you maybe wouldn't choose normally just to make the premium line up. But in this case, Brian, I think, as you mentioned, the skew is so bid up right now in the S&P, again, reflective of the fact that we're maybe a little top heavy here. People are a little bit concerned. They're sitting on some gains. It's understandable they'd want to have some hedging. As a result, those puts are pretty expensive. So another way you can go, the collar is one way, but as you mentioned, the call skew is cheaper than the put skew. So the call is never really going to pay for your put unless you really dial it down to sell pretty much almost an at-the-money call, in which case you're pretty much getting rid of all your gains at that point. So another way a lot of people like to go is to add, what I guess you can call it a kicker. Add a put kicker to this collar. So you're buying your put, you said was $6, then you look down the strike chain a little bit, you do your analysis and decide, now here's the range where I really expect a near-term sell-off I'm concerned about in the S&P. Maybe you expect a sell-off to this level. And so that's where you really want to focus the lion's share of your hedging. Beyond that, you're not really looking for a catastrophic hedge. If you are, then that, of course, stay with that, just that straight put, and that's it. But if you're looking for maybe more of a near-term correction rather than a complete annihilation of the marketplace, then having a reasonable range in mind of where you think the S&P could sell off to in the near term, where you're concerned about, then you have a put you could sell on the outside of that, because you've determined that range in your own analysis. And now you have a nice level and a range. And more importantly, Brian, for I think which will please a lot of our listeners here, you're taking advantage of that skew that's been bid up farther out and away from the at-the-money to actually harvest some of that premium to turn around and pay for that expensive amount of premium you had to pay for that initial put. So, Brian, are you a fan of that? I guess you can call it collar with the kicker, but or maybe just put spread with a short call. What do you like to call it in the playbook?
Well, actually, I don't have a title for it. Maybe that's another strategy we have to come up with. We named the most popular strategy out there the fig leaf. Maybe we need to come up with a name for this. But I like what you're saying. When I look at this, I see, and I'm just following along here looking at the Ally Invest option chains, and I see the 285 put that we talked about. It's trading for 630 on the ask. That's looking at about 19% implied volatility. So why not turn that into a put spread, right? And just give you some of that protection a little bit further down. And I can actually, so I specifically want to look for an extra $3 to help pay for this put when combined with the call. So if I look at the 265 strike put, I see that's trading at 23% implied volatility. So I'm even selling higher volatility than I'm buying. So I'm going to combine that with my call option that is the 315 strike that's only trading at 10% implied volatility, and I can basically get my insurance paid for. So now if I look at this, though, so I have a deductible. So let's evaluate the trade. Let's make this the paper trade for this week, Mark. And as always on Options Playbook Radio, we're not looking to make recommendations, but let's just talk about this scenario. Okay, the market hits 3,000 today in the S&P 500 index. We're going to buy 100 shares of the SPY. SPY is trading at $325. We're going to go on out and buy our protection then. We buy the 285 strike put. That's trading for somewhere around $6.30, we'll call it. And then we're going to sell a call to help pay for it. So we go 15 points up to the 315 strike call. We sell that, and we say, gee, we still got another $3 that we need to cover. And we go down and sell the 265 strike put. All of these are in the January 17th expiration out in 2020. And we can get that entire trade done for a dime. Our insurance for this entire trade is a dime. So if it goes down 5%, we got some protection all the way down for another 5%, down to 265. And on the upside, we still got the upside potential to make another 5% if it goes up. But the whole time between October, December, most of January, we are feeling fairly comfortable because we do have some protection out there. And then we get back to our regular trading when we get into the new year. So it's just kind of an interesting way to approach it. And who says we got to do this in the SPYs? If we got positions on right now, why not think about doing it? Say you got some Apple in your account, you got some Walmart, you have some other stocks that you are long and have had a decent year in overall. This is one little way that you can approach it and get yourself into the new year and give yourself some protection. Now, obviously, you got to be aware that you could end up selling the stock. So in retirement accounts, a lot of people like to do this because they don't really have to worry about any capital gains, and they can put their new position on when they get into the new year. But overall, it's just something you got to think about. And I think this is definitely the time of year to be considering these type of strategies.
Sounds good, Brian. Your point is extremely apt. We mentioned this on our advisors option show quite a bit. I often refer to the collar and whatever flavor you want, the costless, the collar with the kicker, constructing it the way the OIC does, 6 months versus 1 month, all sorts of ways, whichever way you construct it at the end of the day. The collar, I've often said, is the holy grail of options positions for a lot of asset managers and financial advisors out there, but also for a lot of you out there in the retail space who want to just protect your gains in any name. Walmart, like you mentioned, Apple, Amazon, SPY, it works pretty much the same. The skew may be a little bit different, but it's going to shape up at the end of the day fairly similar. And so you could utilize this same technique across a broad spectrum of underlyings that maybe you're sitting on some gains in right now. And perhaps you don't want to give them up, but you also don't want to spend an arm and a leg to protect them. So, Brian, if people are liking this strategy, they want to learn more, maybe they want to kick the tires over there at Ally Invest for themselves, or maybe they want to send you a question directly. Where should they go? What should they do, sir?
Well, as always, you can email them directly to me. My email address over here at Ally Invest is theoptionsguy@invest.ally.com. And as always, thanks for listening. We'll be back at the same time, same place next week. And till then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.